So is Rezolve AI PLC, you know, trading under the ticker RZLV, the ultimate undervalued AI play right now? I mean, it's currently flashing a strong buy with this massive $10.75 price target.
Right. Or are you basically just catching a falling knife in a stock that lost 28% in a single week? Because it is definitely flashing some serious sell signals across the board, too.
Exactly. Welcome to today's deep dive, everyone. We are unpacking the wild, chaotic, and just totally conflicting signals surrounding Resolve AI today.
Yeah, it really is the defining battleground of the market right now. I mean, you have Wall Street analysts pointing to the moon, forecasting this incredible growth, but then retail traders are staring at a daily chart that, frankly, looks like it's in free fall.
It's crazy. And we have a massive stack of sources on the table for this. We're pulling from the latest market data as of midday today, April 13th, 2026. We're looking at their full year 2025 financial statements, the technical charts, and those highly optimistic analyst notes.
Right, and our mission here is really just to map out both the bull and the bear cases. We want to help you understand the actual mechanics driving this volatile stock.
And just to be super clear up front, we are not giving financial advice. We're just looking at the facts, the filings, and the raw data. But before we get into it, make sure to like the video and subscribe to our YouTube channel.
Definitely do that.
And it is compulsory that you leave us your comments and feedback below. We really want to know what you think about this specific setup.
For sure, because to understand the wild swings we're seeing right now, we first have to look at the massive fundamental shift that happened with this company over the last year.
Yeah, let's start with the current snapshot. So just the immediate facts on the ground. As of midday today, RZLV is trading at $2.42. That's up a slight, 1.76% intraday.
But you really have to zoom out to see the real picture. I mean, the 52-week range is huge. It has a low of $1.11 and a high of $8.45.
Oh, wow. That is a massive range.
Yeah, it is. And right now, the market cap is sitting at roughly $815 million, which brings us to the whiplash in the news catalyst driving all this price action.
Right, because on one hand, you have this massive technological win. They just launched their brainpowa commerce models on Microsoft Foundry. And that isn't just a shiny PR win, right?
Absolutely not. Microsoft Foundry is an enterprise-grade platform. I mean, Microsoft basically stress tests these AI models for security, latency, and scale before they let their massive corporate clients anywhere near them.
So by getting onto Foundry, Rezolve bypassed years of typical enterprise sales friction. They didn't just get a badge, they got direct access to Microsoft's global Rolodex.
Exactly. That is top-tier validation for their tech, but, the market isn't just pricing in a Microsoft partnership.
Right, because on the other hand, you have this heavy selling pressure dragging the stock down, and that pressure is coming from their recently rejected hostile buyout attempt for Commerce.com.
Which is just wild. I mean, a hostile buyout attempt by a growing AI company targeting a legacy cash cow commerce site. That is a highly aggressive, super unorthodox move.
It really is. Like, why would a cutting-edge AI company even want to buy a legacy e-commerce platform in the first place?
Well, it's a data play. To train an AI commerce model to actually be effective, you need massive amounts of historic transaction data. You need to know how consumers behave, what they abandon in their carts, how pricing impacts conversion.
Ah, I see. And Commerce.com has decades of that proprietary data. So Rezolve was essentially trying to buy the textbook to teach their AI.
Spot on. But the market hates it. Hostile takeovers are notoriously expensive, and they're highly distracting for the management team.
And to understand why the market got so spooked by the cost of that potential acquisition, we have to look under the hood at their cash situation. So let's dive into these full year 2025 financials.
Yeah, the income statement here is basically a story of two extreme realities. On the plus side, the revenue growth is undeniable.
Right, they transitioned from a tiny, almost negligible $2 million in revenue in 2024 to a massive $46.8 million in 2025.
Yeah, that is the kind of scale-up that gets Wall Street paying attention. But, and this is a huge but, they are deeply, deeply pre-profit.
I mean, despite making almost $47 million, they posted a net loss of over $101 million. That is a diluted earnings per share of negative 38 cents.
And the primary driver of that loss, astronomical selling, general, and administrative costs. Their SG&A was roughly $113 million.
Wait, really? Revenue grew exponentially, but they spent over $113 million just on SG&A to make $46 million. Is this aggressive scaling or just reckless spending?
Well, let's make this tangible. It's like building a massive state-of-the-art highway in the middle of a desert. They spent $113 million paving the roads, hoping that once the Microsoft Foundry integration acts as an off-ramp, the enterprise traffic will magically appear.
Oh, I get it. So it's a massive build it, and they will come gamble to justify the construction costs.
Exactly. In the AI sector, SG&A isn't just paper clips and office leases. It is leasing massive amounts of cloud compute power. It's hiring machine learning engineers who command, $500,000 salaries.
And aggressively funding an enterprise sales team to get their product in front of Fortune 500 companies. But we have to look at the balance sheet to see if they can survive that highway construction.
Right, let's look at the safety net. Total assets are sitting at roughly $611 million. But the liquidity is the real story here.
They have about $111 million in cash against $157 million in debt. That puts their debt-to-equity ratio right around 64%.
Yeah, and when you look at the cash flow statement, they have a $63 million operating cash outflow. They are bleeding cash from their core operations just to sustain this hypergrowth.
So with a $63 million operating outflow, that $111 million cash cushion suddenly doesn't look like much of a cushion at all. It looks more like a ticking clock.
It absolutely is a ticking clock, and the only reason they even have that liquidity right now is because of roughly $188 million in financing inflows.
Right. You don't just organically hold $111 million when your core business is burning $63 million a year. They tap the markets.
They did. The vast majority of that came from a massive $250 million follow-on equity offering they executed in early 2026.
And raising $250 million in equity means dilution. You're creating millions of new shares, dropping them onto the open market, and naturally pissing off retail investors because everyone's slice of the pie gets smaller.
Exactly. It mathematically lowers the ceiling on the stock price because the market cap is now spread across a much wider float.
So they're bleeding cash and diluting shareholders to survive. Which leads us perfectly into the current technical setup and order flow. Because you'd think the chart would just be a flat line, but there's a vicious tug of war happening.
Yeah, when you look at the technicals, the reality of that dilution, combined with the commerce.com distraction, has created a severely falling trend.
Like we mentioned, the stock suffered a 28% loss over the previous week. So the trend direction is objectively neutral to weak right now.
And support and resistance aren't just magic lines on a chart. They are psychological zones where massive limit orders sit, waiting to either catch the falling knife or sell the rip.
Let's lay out those battlegrounds for you. Immediate support is at $2.35. If the selling pressure breaks through that floor, there's a stronger historical support down at $2.20.
Right, and on the flip side, overhead resistance, the ceilings they need to break through, sit at $2.57 and $2.82.
And technically speaking, RZLV needs to break above the $3 mark with sustained volume to signal any real trend reversal.
Right. Yeah, anything trading under $3 is just playing in the chop, bouncing between those floors and ceilings. And the moving averages are highlighting a lot of negative signals right now.
Yeah, the stock is trading below its 50-day moving average, which is at $2.57. That's your short-term bearish indicator.
But the 200-day moving average is sitting way up at $3.49. When the price is a full dollar below the 200-day, that indicates deep long-term bearishness. The trend has been broken for months.
And then we look at momentum. The relative strength index, the RSI, is currently sitting at 46.4. Now, I have to push back on this.
Oh.
Well, an RSI of 46.4 is technically neutral, meaning it's neither overbought nor oversold. But given that it just dropped 28% and is still pinned under its 50-day moving average, doesn't that neutral RSI just mean the market is holding its breath to see if that $2.35 support cracks?
That is an incredibly important distinction. It feels less like neutrality and more like sheer anxiety. It's a tense, fragile neutral.
Yeah, and we can confirm that exact tension by looking at the order flow, right?
Definitely. Buying support is currently consolidating just above that $2.40 psychological level. Day traders and algorithms are stepping in, trying to catch it.
But the real tension isn't just about the price levels. It's about who is actually involved in this stock right now.
Right, because you have major institutional buyers like BlackRock and Citadel holding significant positions in Rezolve, But on the other side, retail traders are getting absolutely chopped up.
Yeah, retail's buying the dips, getting stopped out by the volatility, and just taking losses, which brings up a massive disconnect.
You have to ask why institutions buy into a falling trend. Citadel and BlackRock aren't day trading this. They scale into positions over months.
Exactly. They might be hedging other investments, or they have a 5-year horizon where a 28% weekly drop is just noise. But retail traders don't have the margin or the patience for that kind of drawdown.
No, they don't. And that massive disconnect between a stock struggling to hold $2.40 and the rosy projections of Wall Street analysts brings us to the ultimate debate.
Yes. Is this a generational value play or just a classic retail trap? Because despite the 28% drop and the bearish moving averages, the consensus analyst rating is a strong buy.
It's wild. The average price target they're putting out is $10.75.
I mean, that's a potential upside of 340%. You really have to wonder what they are looking at to get to $10.75. They have to be pricing in an absolutely flawless future.
Well, they are. The bull case, the absolute best case recovery scenario that these analysts are anchoring to, is entirely based on unprecedented revenue scale-up.
Right. Remember, they saw 543% growth in the second half of 2025.
Exactly. And the medium to long-term guidance projects $360 million in revenue for 2026.
Which is a massive leap from 46 million.
It is, but the holy grail here is that they are targeting a $500 million annual recurring revenue, or AR, by year-end 2026.
And Wall Street loves ARR because it's predictable, stable income. An AI company with a guaranteed $500 million in recurring revenue commands a massive valuation multiple.
Right, so the bulls argue the stock is incredibly undervalued if you value it based on that future $500 million ARR rather than its current cash burn. Plus, the Microsoft Foundry integration gives them massive tech credibility.
I see the vision, but I have to counter with the bear case because the downside risks are severe. The high cash burn is basically eating the company alive today.
Oh, absolutely. If they keep burning $60 million in operations, they are going to run out of that $111 million cash cushion before they ever reach that ARR target.
And if that rejected, hostile bid for commerce.com turns into a protracted, expensive, and ultimately failed acquisition strategy, it's just going to drain resources.
Right. It becomes a massive distraction at the exact moment they need intense focus on scaling their core product.
And the worst-case continuation lower involves that $2.20 floor breaking. That would force another equity offering, further diluting the shareholders who actually stuck around believing the $10 price target.
Which is exactly why retail traders often get trapped here. They see a stock that was at $8.45, now trading at $2.42, and their brain triggers an anchoring bias. They think it's cheap.
Right. They anchor to the past high, assuming it has to return there. They don't realize the massive increase in outstanding shares from the dilution has completely changed the math of what the stock is actually worth today.
And then they look at the filings, see Citadel and BlackRock backing it, and assume it's a safe bet. But institutional money can afford to wait out years of volatility and dilution.
Yeah, retail traders often get stopped out or panic sell during the short-term weakness, while the institutions hold for the 5-year horizon. It's the classic promise of tomorrow versus the price of today.
That is perfectly said.
The company is selling the dream of 2026, but retail investors are paying the daily toll of 2025's cash burn.
And that dichotomy perfectly defines the short-term versus long-term outlook for RZLV. You really have to know your personal time frame if you are looking at this data.
So based on everything we've dissected, what is the final outlook summary? Let's break down the timeline.
Okay, so short term, meaning the next few weeks, expect heavy volatility. The market is still actively trying to digest the hostile commerce.com bid and the Microsoft Foundry news.
It's just a daily battle of narratives between buyers and sellers right now.
Yeah, but long term, there is a very clear growth roadmap to that $360 million in 2026 revenue. The big caveat is that's only if management can control the burn rate and avoid drowning in their own SG&A costs.
Right. And remember, everyone, we are just here debating the data and having a natural human conversation about the facts. None of this is financial advice, and you have to do your own research.
Absolutely. Do your own due diligence.
But I want to leave you with a final provocative thought, something to really ponder. Major institutions like BlackRock and Citadel have massive
Oh,
resources.
yeah. Huge teams of analysts.
They know about the $101 million net loss.
Mm-hmm.
They know about the $250 million dilution. And they saw the stock drop 28% last week, just like the rest of us. Yet they are in.
They are holding in positions.
So what do they see in the proprietary data of that Microsoft Foundry integration that retail traders are missing? Or are the big boys just using retail traders as their exit liquidity while the hype lasts?
That is the ultimate question. It really determines whether this is a trap or a massive opportunity.
Exactly. Thank you so much for joining us for this deep dive. Keep questioning the consensus and keep diving deep into the data. We'll catch you on the next one.